According to Raymond James Chief Investment Officer Larry Adam, we have a lot to cover from last month. A torrent of headlines churned U.S. equity markets in February, which, bolstered by the underlying strength of the U.S. economy, closed downward, but still near record highs. Here's a quick rundown of the ongoing tensions as of right now. First, the Trump administration's threat to enact broad-based tariffs on goods imported from Canada, Mexico, and the European Union, and to double the new tariff on China, has created uncertainty for producers. The effect on the market may be muted thus far by investors biased towards seeing the threats as primarily a negotiating tactic. Second, Federal Reserve policymakers remained in a wait-and-see mode following mixed January inflation reports and a number of weak economic growth reports. Until there is more clarity, this combination of factors will likely stay the hand of the Federal Open Market Committee from lowering interest rates even further. Third, the release of an AI model from China at the end of January called into question the U.S.'s AI dominance and AI stock valuations, as well as expectations for related capital expenditures. And finally, congressional leaders and the White House are eager to pass a significant budget, tax, and debt limit package. But with their narrow House majority, Republicans may find consensus difficult, increasing the risk of a government shutdown. The chances of a government shutdown are increasing. However, shutdowns have historically been a non-event for the market. 80% of the time, the market is higher 12 months later. Investors need to look past the noise and continue to focus on the fundamentals. A larger than expected increase in the January Consumer Price Index report released on February 12th was a setback in the Federal Reserve's ongoing battle against heightened inflation, which could lower expectations for interest rate reductions through 2025. However, the report could be the result of a spike in the trade deficit as producers overbought materials in December as a hedge against tariffs or residual seasonality, a spillover from the holiday season's elevated spending patterns. The Personal Consumption Expenditures Index, which is a broader measure of inflation and the one preferred by Federal Reserve policymakers, offered a counter to the CPI. Released on February 28th, it showed inflation slightly cooling in January, in line with earlier expectations, helping the down month close on an up day. Investors might naturally expect a muted 2025 after back-to-back years topping 25% gains for the S&P 500, regardless of other events. But underneath headline-driven uncertainties, there could still be some gusto left in the bull market. The U.S. economy remains in good shape. AI remains a powerful mover, and bull markets historically pull for a bit longer, which has kept valuations high. Eyes remain on tariffs, inflation, and interest rates. Capping off February, the U.S. House of Representatives passed a budget resolution providing the foundation for reconciliation with the Senate's budget efforts. The budget instructions over a 10-year timeframe included $4.5 trillion in potential tax cuts, $2 trillion in spending cuts, and a $4 trillion debt limit increase. Beyond tax changes, the budget provides for $300 billion in additional spending for defense, immigration enforcement, and energy priorities. House leadership has set a Memorial Day deadline to complete the process, with the summer X-date deadline to address the debt limit, potentially accelerating the process. But the path forward will likely see a significant number of political decisions and hurdles. Here's the bottom line. As expected, the newly empowered administration spent its first full month vigorously pursuing its policy ideas and setting an agenda backed by a friendly, if narrowly so, Congress. While some of Trump's 2.0 moves are familiar, others are new, and the world and the markets are early in their efforts to triangulate to this new dynamic. The strength of the U.S. economy continues to offer stability despite the cacophony of daily headlines driving volatility. The market expects this volatility to continue from inflation, interest rates, and policy uncertainty, and is thus far not overreacted. And that's all for this month's market recap. If you or your family have any questions or would like to speak to my team and I to get your financial roadmap laid out, please don't hesitate to reach out anytime. And as always, thank you for watching and have a blessed day.